Netflix is interesting, and here's why. We love repurchasing shares when they're cheap. So I want you guys to see, what's the bait on this company?
I think they had a massive spike in viewership.
Wait a second, what's going on here? What's the reason for that? Guys, big up and down in the stock. Netflix, this thing has been insane. Let's look it up in our stock, in our software here.
Wow.
Look at this.
I just looked at it.
700 high on November 17th, 2021. It hit, since then it hit 180 or 160, I think at one point.
164.
164, oh yeah, in June of 2022. And now it's back up to 367.
So this thing went from 701 to 165 in a matter of 7 months.
So I want you guys to see, what's the beta on this company? Because I want to show people this beta stuff that like just drives me nuts in the companies. But anyways, what's happened recently? They shot up big time because they have 5 million people who are in their light ad tier. 5 million people. Okay, now Netflix is interesting, and here's why. I'm gonna show you guys why initially Netflix is concerning to me. Profit margin, 10 to 13%. Free cash flow, much, much lower. Now, I'm glad the last year the free cash flow is much closer to the profit margin, but that's always a concern of mine. When profit margin is much higher than free cash flow margin, it tells me, wait a second, what's going on here? What's the reason for that? Mo, what were you gonna say?
The beta is 1.27, which sounds absurd.
That sounds low.
Very low.
I always thought it was much higher.
Yes.
Beta is the change versus the market.
Yes.
I mean, look at this big drop. Look at this big drop. Okay, Mo, give us some bull and bear cases for Netflix.
So the bull case, and this blew me away. Netflix is the #1 streaming service. They have 44% of the market share. The second closest is Hulu with 21%.
So over double.
Yeah. Now, when you talk about this isn't really a bull or bear case. We had this written down. Free cash flow was higher than net income due to a $647 million amortized expense over cash payments. Now, you remember that one live stream that we did a couple of months ago, and we were trying to figure that out, and that was the reason.
What is
the way that they amortize their content?
Yeah, but my question was, if you remember, okay, great, but how much life are they giving a content that might, like if the content is life is 5 years, but yet look at what's called Queen's Gambit.
Queen's Gambit.
Is that still popular?
The lifespan of that was like 2 months.
Yeah, I mean, it was very quick.
I mean, it's still going, of course, but the spike of it was like.
So I'm wondering to myself, is that real or is that a manipulation? And also,
I don't think
spoiler alert, I've heard Reed Hastings talk.
You hate him, right?
Can't stand him. I just think he's a tool, likes to hear himself speak, which says from the guy who has a YouTube channel talking about investing is probably a little weird to hear. But go ahead. What else you got?
Let's go to some bears. Repurchase shares. You're going to love this.
Oh, God.
At 36 times trailing 12 months earnings at a cost of $333.
Okay, guys, so I want to go over this. We love repurchasing shares when they're cheap. This PE is 39 currently. 5-year PE is 50. Is it cheap? Maybe. I doubt it, though. But a lot of times companies repurchase shares because they have nothing better to do with the cash. But when they're buying back their own expensive shares, that is hurting you as an investor. They're taking your capital that you have a right to and investing it into an expensive business. Even though they're buying their own shares back, they're basically investing in themselves. And that is awful. Go ahead, Mo.
Netflix has lost 5.5% of market share from the first quarter of 2022. I think a lot of that goes to, well, number one, competition.
Streaming is becoming a very, very competitive space.
Increased prices. Yeah. I mean, there's a lot of different things going to it. New subscriber costs have increased year over year from $39.70 in Q1 of 2022 to $51.15.
And I imagine that's going to keep going up. Because guys, as there are more and more streaming services and Netflix become bigger and bigger, to get the people who have not signed up will cost more and more money.
Yep, especially as those other people have other streaming services that they need to pull them away from.
Yep.
Yeah. And the last one, Netflix traffic down from July of 2022 to March 2023, 30%. But again, people were home watching Netflix. I think they had a massive spike in viewership.
Well, I'll tell you right now,
back to reality.
I have like a ton of streaming services.
Yeah.
I don't go to Netflix immediately anymore.
My go-to right now is YouTube TV.
Oh, mine's Showtime and HBO.
Either content or live television.
Or Skinamax.
Oh.
That's a joke from Wayne's World.
I figured you actually did that.
No. All right. So high return on invested capital, 11% over the last 5 years. For a growing business, that's pretty solid, guys.
Yeah.
Decent profit margin, 13%.
Better than I expected.
Gross margin of 38%. That's probably going to be driven down as their costs go up. But if they're able to drive their revenue up, it could end up working itself out. Let's look at analysts and what they're saying. Actually, pull up their 8 pillars first, Mo.
Yeah, it's not good.
Ooh,
Not good.
well, 4X's, 4 checks, 4X's. There's no free cash flow in the last 5-year average. Oh boy. But last year's free cash flow is pretty solid, $3 billion.
Yep.
Analyst estimates, earnings. Oh wow, big jumps in earnings, Mo.
I had a feeling they would love it. Oh my
I didn't think they would. That's over doubling earnings next 5 years. Revenue growth, high single digits, low double digits.
I don't know about this one.
All right, guys, now we're gonna do the stock analyzer tool. Before you leave the video, Mo is going to actually, if the stock is way below and it's all red, he's gonna put in the highest assumptions what numbers it takes to even get green as a buy signal to justify today's price. All right, let's do an analysis, Mo. You know I'm gonna do this one? You do 5 years, I'm gonna do 10 years in this one.
Okay.
Because I don't wanna own Netflix for 20 years.
I don't want to own Netflix for 0 years.
Well, let's figure out the right price for Netflix that we want to own it for
Okay.
right now. All right,
There's there's so many things in here. I'm just scratching my head.
I know.
You know, that's the thing.
So revenue growth. Let's see here. I'm doing, yeah, okay, that's pretty solid. Then let's go.
What did the analysts say here?
Let's see if they're able to increase margins a little bit. Okay, there we go. PE. I can't wait to have this conversation with people. So the thing is, guys, we're all making assumptions and they always change. You watch our videos, we're always changing our assumptions. But the key is that it's not going to go from one time we say it's worth $80, next time it's worth 500. Our low and high might be that big of a difference, especially as I go at 20 years. But here I'm doing a 10-year analysis. Now, desired return. This is interesting. This is a fun one.
Yeah. All right. Let's see.
All right, so what'd you do for your revenue growth over the next 5 years, Mo?
I did 6, 9, and 12.
Okay, I did 3, 6, and 9 for 10-year revenue growth.
Yeah.
Okay, so Mo's expecting bigger jumps in revenue based on what we saw the analysts saying, right?
I was kind of going off what analysts are saying, yes.
And I'm going more conservative because I'm doing a 10-year analysis, but I also, think there's a lot of competition to come. Okay, profit margin.
12, 14, and 16.
Okay, I did 11, 13, and 15.
All right.
So I stuck with their 13 as the middle. And I said, okay, let's say things get tighter, costs go up, et cetera. Maybe they'll be at 11. And if they do really well, maybe they'll be at 15. A couple other streaming services fall the wayside, et cetera.
Free cash flow. I just put in 3, 5, and 7. I legit have no clue. It's so inconsistent.
I know. I put 9, 12, and 15.
Okay.
Because I'm hoping this is the start of something.
Okay.
That's a big if.
Yeah.
All right, PE, Mo.
I did 15, 18, and 21.
Now remember, guys, I did 15, 17, and 19, and you're looking at 39 PE. Your PE should not be based on where the current PE is.
Right.
It should be based on something about the ROICs and their growth rates and the moat they are. The higher the moat, the higher ROIC, the higher the growth rate, the higher your PE and price of free cash flow should be. But I think for Netflix, it can justify a minimum 15 PE. Mm-hmm. And your price of free cash flow, you did the same thing?
Same thing, yes.
So did I. 15, 17, 19.
All right.
Desired return.
I should change this.
So I'm going 12.
I should actually change it to 12, 14, and 16.
I actually agree with you on that one, Mo. I did 12, 13 and a half, and 15%. The higher my desired return, the bigger the margin of safety. And I'm great with that.
Yeah.
Mo did 12, 14, 16. It's a shorter term play. Let's hit the analyze button.
Oh my goodness.
It's going to be awful.
Awful.
Guys, low price 80 to 100, high price 200, middle price 130 to 140. Guys, it's just too expensive.
Yeah, I'm 33 to 133, 110 to 250, 66 to 185. And bottom line, too expensive.
And for those of you who say, oh, it's not going to go that low, it was 160 very quickly, went from 700 down to 160 in a matter of less than a year.
And that's with 12% revenue growth for the next 5 years.
It's just expensive.
Okay, yeah. So I got it to justify today's price. Revenue growth, 12%, which I think is absurd for the next 5 years. Profit margin, which they have not done, 16%. Free cash flow margin, 9%. They did it last year. A PE of 25, a price to free cash flow of 25, and a return of 10%. I had to drop the return to 10%. That puts it as a multiple of earnings worth today's value.
So if you think that Netflix will do that, you should buy it for today's price. You're going to buy a 10% return.
Absolutely.
Okay, great.
If you think they can start those profit margins right now with that revenue growth, go for it.
But you got to be ready for a lot of volatility.
Yes.
Because you've already seen it in this company, and it's going to be very volatile going forward. All right, guys, thanks very much. Our software, $7, 7 days, $1 per day. Go to everythingmoney.com, sign up for it. Take care.